So, Gino, I'm going to throw it to you first with one of my questions. I know that people are very concerned about the state of the economy, especially around this COVID-19 period. Can I ask you to give us your view on the state of the market, particularly the stock market, and what it's done to some investment yields, and what people are feeling in this current market, especially people like your clients, who I know a lot of them are self-funded retirees.
The state of the market, well, you've given me a bit of a challenge here to try and talk about this in literally a couple of minutes, but clearly there's a lot of uncertainty in the markets at the moment, and some of that actually existed before COVID-19 hit us. So what I'm seeing is that COVID has potentially exacerbated some concerns that existed previously. So all of this has created some pretty challenging circumstances for retirees. I've got a bit of a slide there, Mike, so how does this... just some of the main concerns, there's a lot of them, but the market volatility is obviously creating a lot of concern for people. And there's a lot of uncertainty, there's a lot of negative press out there. It's very easy to get caught up in the negativity that's coming out of a lot of the financial commentary at the moment. And I think as advisors, it's actually really important that we play a role at the moment to keep our clients making very well considered decisions, and it's really important to put things into perspective. So I'll put up a slide in a moment in relation to what the long-term perspective is for share markets, because I think it's really important that we don't get caught up in making perhaps ill-considered decisions at the moment in terms of investments. The other challenges, preparing for lower yields and investment returns. So even before COVID hit, I'm sure everyone's aware that interest rates are at record lows, and it has been in that sort of decline for some time. And COVID is potentially going to just make that issue worse and potentially last longer. So for self-funded retirees, the prospect of not earning any interest in your bank account is pretty daunting. And if you look at some of the economies overseas where interest rates are in fact negative, it's quite difficult to contemplate how that can actually happen. But it is a reflection of perhaps a lot of lack of confidence in markets, and the need for governments at the moment to spend and stimulate, and that's obviously one of the main levers they've got to do that. So that in itself is creating a lot of uncertainty for people. How do we fund? Well, we understand there's risk out there, we understand that we need to be a bit more defensive, but how do we fund ourselves without being in a position where we're losing access to capital growth? That's certainly a bit of a challenge for retirees at the moment. There's a lot of complexity around financial management generally, always has been, but add on to that the Royal Commissions that we had before COVID-19 with the banks and financial planners, and yet another concern for a lot of people around who can we trust, who do we go to for advice. This is a time when getting good advice is quite important, but who do you go to? The other concern I have with retirees at the moment is that that fear can lead to procrastination, and that in itself can be a problem. This is a time when people need to revisit their financial affairs and reset their expectations and their planning going forward for the long term. It's a pretty major event that's happened, and it's important now to look at revisiting your financial plans. But one of the concerns is being completely defensive at the moment is not necessarily a good place to be. If you've got all of your investments in cash, and this government stimulus that's happening across the globe results in inflation, you could be in a pretty difficult situation where your cash is actually going backwards with inflation, cost of living rising. That can be a big problem. Centrelink pensions, where government just announced very recently that they're not indexing them. I can't remember the last time they've actually done that. So this is the first time they said we can't afford to index pensions. So there's a lot of uncertainty with people relying on pensions. Mike, just quickly, if I can just put up a chart just to put some perspective on this market volatility. Now you probably can't see that, so I'll just talk to it very quickly. The reason I'm putting this chart up is that putting perspective on the markets is important. This is the last 30 years. The top line is US shares, which if you had have invested $10,000 30 years ago, would now be worth $186,000. This assumes that you reinvest dividend returns. The next line below that is the Australian share market, and that shows a total value 30 years down the track. If you had have invested 10,000 and reinvested the dividends, that Australian share portfolio would be worth 130,000. And this is obviously looking at the top ASX 200. Listed properties, the next one down, $95,000. Australian bonds, 93,000. International shares, 82,000. Cash, 44,000. So if you kept your money in cash over that 30-year period, it would have accumulated $44,000. The one at the bottom is the one that we're very conscious of, and that's CPI. So CPI has gone up 20,000 over that last 30 years. So if you had have been very conservative and invested purely in cash, you've made $24,000 above CPI in that time frame. And the very top there, if we just take Australian shares for the moment, the orange line, 130,000. There's a big difference there. Now you can also see how volatile those growth assets are, the share market. You can see the volatility there. This does take it right up to June 20, so you'll see there's a bit of an uptick there. I'm sure you're all familiar that Australian market had dropped well over 30% in March. It's recovered more than half of that in a very short time frame. So, that volatility is concerning, but we have to get used to expecting that to continue. But it's really important. The message here is really important to have a plan that is sustainable for your own circumstances. And I can't emphasise enough, Mike, right now. Important to make really well considered decisions that are relevant to your own circumstances in terms of your investments. Very quickly, state of the economy. Can I just share an example of what's happened? What I'm seeing happening in WA, there's cautious optimism here in WA. So despite all this doom and gloom, we're sitting in a pretty good place. Our resource sector, looking at our clients and how their outlook at the moment, the resource sector is looking very buoyant. The residential construction with the stimulus is looking good, and there's a lot of expectation around government expenditure also being very positive for WA. So I think we're in a really good place here. And there's a lot of positive things that perhaps people are overlooking at the moment. Our biggest challenge is going to be skilled labour coming into WA, and having a very stringent locked border is actually creating challenges for our clients at the moment, our business clients, because they simply can't proceed with some of the projects. Because of the lockdown, there's a lot of projects that have been put on hold. But there's also concern about the lack of skilled labour arising now in WA as well. So it's a bit of a chicken and egg situation. Yield compression, I think we're all aware of that. Banks are reducing their dividends and interest on your bank accounts reducing. So it's a big challenge at the moment to counteract that.
Home downsizer super contributions. Gino, obviously the big benefit there. Do you want to maybe just touch on that?
Absolutely. Look, Michael, one of the strategies that we've helped clients with, where they're wanting to boost their investment base because they're realising they've got potentially less return coming from their investments, and they're wanting to take a more defensive approach. One avenue is to downsize out of your home, and there are some rules now that allow you to. The government has done this recognising that people need to top up their super because the super is simply not delivering enough return. So what they're saying is that they'll allow you to put up to $300,000 per person out of the sale proceeds of your home into superannuation to boost your investment base. So that's a bit of a concession that you wouldn't normally be able to get access to. And there are some fairly strict rules. There's a bit of detail to that. So it is important you get advice before you do that. As with everything with our tax system, unfortunately it's a bit complex and it's easy to trip up on, but it is a really good opportunity.